Let me ask you something. Right now, today, if I asked you how much profit your landscaping business made last month, could you tell me? Not a rough guess, not what you think is sitting in your bank account, the actual number after every expense is accounted for. If you hesitated on that, this video is exactly what you need. I'm Tasha with West Financial Services LLC, and we work exclusively in tax planning, bookkeeping, and financial education for small business owners. And a significant portion of our clients are in the landscaping and lawn care space. I see the same problems walk through the door repeatedly, and most of them trace back to one thing. The business never had a real bookkeeping system in place. So today we're fixing that. We're going to cover 4 things: why separating your finances is the non-negotiable foundation of every healthy business, how to actually track your income and expenses in a way that makes sense for a landscaping company, how often your books need attention and why, and the 3 bookkeeping mistakes I see most often and what they actually cost you. So let's get into it. The single most important step in bookkeeping has nothing to do with software, nothing to do with categories, and nothing to do with hiring anyone. It's this: separate your business finances from your personal finances completely. That's the foundation. Everything else we talk about today is built on top of that. Here's why this matters so much, and I want you to actually hear this, not just nod and move on. When your business money and your personal money are running through the same account, you don't have a business. You have a hobby with a truck and some equipment. I know that sounds harsh, but it is the truth. The IRS doesn't look kindly on commingled funds, and your bank account doesn't look kindly on it when you go for financing, and your accountant is going to charge you a lot more to clean it up than it would have cost you to do it right from the start. Now, from a purely practical standpoint, think about what it costs you operationally. When business and personal monies are mixed, you can't accurately calculate your revenue. You can't accurately calculate your expenses. You can't know your profit margin. You can't prepare a clean profit and loss statement, which means your accountant is working from incomplete or inaccurate information at tax time. And when you get to tax time and realize you have 11 months of mixed transactions to sort through, or you hire someone like me to do it, you're paying for that mistake in both money and in time. Open a dedicated business checking account if you don't have one today, not next week. Every payment from every client needs to go into that account. Every business expense, fuel, equipment, materials, insurance, software, labor comes out of that account. Your bank statement becomes a financial record. This is what we're going for. So once your business checking account is open, the next move is a dedicated business credit card. Now, you want to use it specifically for recurring, predictable business expenses. Things like fuel, supplies, subscriptions, small equipment purchases. Pay it in full every single month, no exceptions. And then 2 things will happen when you do this consistently. First, your credit card statement becomes an automatic time-stamped expense log. Every purchase is categorized, dated, and documented. That matters for taxes. That matters if you're ever audited, and that matters if you go to apply for business financing and someone asks you to demonstrate your expenses. A clean credit card history tells the story without you having to reconstruct anything. Now, secondly, you're building your business credit profile. Business credit is separate from your personal credit score, and most landscaping business owners are not building it intentionally because no one told them to. A strong business credit profile opens doors. You get better financing terms, higher credit limits, trade accounts with suppliers. It's a long game, and the best time to start is right now. So when I talk about separating your finances, I mean all of it. Business checking account, business credit card, used consistently and paid responsibly. That is the infrastructure your business finances run on. Now that your financial infrastructure is in place, let's talk about how you actually record what's coming in and going out. There are 2 approaches to doing this: a manual spreadsheet or accounting software. Both can work, but for a landscaping business that's actively growing, accounting software is going to save you significantly more time than a spreadsheet ever will. And it produces financial statements your accountant can actually use. Now, whatever tool you choose, the most important thing is your category structure, because your categories are what translate your bank transactions into meaningful financial data. They show up on your profit and loss statement, they show up on your tax return, and if they're too vague or too generic, you're leaving money on the table at tax time because your deductions aren't being captured accurately. On the income side, a landscaping business typically needs to separate recurring maintenance revenue from installation or project revenue, and from any specialty services like irrigation, lighting, or hardscaping. So why does that matter? It's because those things are different types of work with different margins, different expenses, and potentially different tax treatment. Lumping all of your revenue into one line called sales tells you almost nothing. On the expense side, the categories you want to be tracking specifically are fuel and mileage, equipment purchases and repairs, materials and supplies, subcontractor labor, vehicle expenses, insurance, marketing and advertising, software and tools, and professional services, which includes what you pay your accountant. Each of these is a legitimate deduction. Each of these needs its own line, and when everything is categorized correctly, your profit and loss statement gives you a real picture of where your money is going, and your tax return reflects every dollar you're legally entitled to deduct. Here's a question I hear often. How frequently do I actually need to update my books? And my answer is weekly. Set aside 30 minutes once a week. That's it. Go through your transactions, verify that anything that was auto-imported and auto-categorized is correct, and then flag anything that needs attention, and then move on with your day. When you're consistent, 30 minutes a week is generally all it takes to maintain clean books in a real time. The alternative is waiting until the end of the month, waiting until the end of the quarter, waiting until January when your accountant needs everything. And then what used to take 30 minutes in a week turns into days of painful reconstruction or a large bill from your bookkeeper to do it for you. The 30 minutes now is always cheaper than the hours later down the line. And here's something I want to reframe for you. Your books are not a tax document. They're not something you pull out once a year and hand to your accountant. They're the financial dashboard for your business. When your books are clean and current, you can look at your profit and loss statement at any point in the year and know exactly what your business made, what it spent, and what is actually left over. You can see which service lines are performing and which ones are draining your resources. And then you can make real decisions about hiring, about equipment, about pricing, decisions based on actual numbers rather than your gut feeling. That is what good bookkeeping gives you, not just compliance, control. Now, before I close out, I want to talk about the 3 bookkeeping mistakes I see most consistently, because knowing what to avoid is just as important as knowing what to do. And I want to be direct about the consequences, because understanding what these mistakes actually cost usually motivates people to change. So mistake number 1, using your business account for personal expenses. I already talked about why separation matters, but let me be specific about what happens when you break that rule, even occasionally. Every personal charge that runs through your business account creates what's called a non-deductible commingled transaction. It has to be identified, documented, and excluded from your business expenses. If your books are being reviewed by the IRS and they find a pattern of personal expenses running through a business account, that's a red flag. It raises questions then about all of your expenses, not just the personal ones. So one habit done wrong contaminates your entire financial record. So let's keep it clean. Mistake number 2, not keeping receipts. The IRS requires supporting documentation for business expenses over $75, not just a bank or credit card statement entry, but actual documentation showing what was purchased, when it was purchased, and why it was a business expense. Most accounting platforms have a receipt capture feature built in. Take a photo at the point of purchase, attach it to the transaction, and it's done. This takes 15 seconds. The cost of not doing it is losing the deduction if you were ever audited, and then potentially owing back taxes plus interest on an expense you legitimately paid. Now, mistake number 3 is skipping monthly reconciliation. Reconciling your account means comparing what your bank or credit card says to what is recorded in your books and making sure they match. When you reconcile monthly, errors, duplicate entries, missed transactions, and fraudulent charges get caught quickly within 30 days. But when you skip reconciliation for months at a time, small discrepancies compound into major problems. By the time you find them, the records that would help you resolve them are harder to access, and you may be dealing with tax filings that were prepared on inaccurate data. A monthly reconciliation takes 15 to 30 minutes, and it's not optional if you want books you can actually trust. Good bookkeeping is not glamorous. It is not the part of running a business that anyone gets excited about, but it is the part that determines whether your business is actually building something or just staying busy. When your finances are separated, your transactions are categorized, your books are current, and you're catching mistakes early, you're running a business that has real financial clarity. And financial clarity is what allows you to grow confidence instead of guessing. Now, if you want to go deeper into any of the topics we covered today, whether it's tax strategy, QuickBooks setup, or how to structure your business finances for long-term growth, make sure you're following us. We put out financial education specifically for landscaping industry businesses, and there is a lot more where this came from. This is Tasha with West Financial Services, LLC. Follow us for more tax strategies and financial education specifically for the landscaping industry.